This lecture on the presentation of financial statements concludes the scope of work of Part 1 series of this course, Introductory to Financial Accounting. Part 2 series will resume in the next 3 weeks. We will approach the topic using IS1, being the accounting reporting standard for the presentation of financial statements. The objective of this statement is to prescribe the basis for preparation of general purpose financial statements. It also sets out the guidelines and minimum overall requirements for their content. The standard also ensures comparability with both the entity's current financial statements with the previous period, as well as other entities' financial statements. The objectives of general purpose financial statements is to provide information to a wide range of users in making economic decisions about the entity's assets, liabilities, owner's equity, income, and expenses. In reviewing the scope of work covered using the accounting cycle, in the transaction stage, we were able to analyze, to classify, and interpret basic accounting entries in order that these entries can be recorded into various subsidiary journals as well as the subsidiary ledgers. Thereafter, at the end of the month, the subsidiary journals were posted using the double entry principle into the general ledger. Among others, we created control accounts such as the SARS VAT account, where we recorded transaction for input and output VAT. We created the bank account where we posted the receipts and the total payments in order to calculate the closing balance of the bank account before the reconciliation. We prepared accounts such as the accounts receivable and the accounts payable, calculated the closing balances of these accounts before the reconciliation. In this lecture, we will be looking at the last remaining 2 stages, which will be stage 4, being the preparation of the trial balance. In between stage 3 and stage 4, we have prepared the general journal in order to deal with the errors and omissions that we might have created while posting into the general ledger. We also dealt with adjustment accounts such as the credit losses, the depreciation account, as well as the disposal of assets. In stage 4, we will be dealing more with some adjustment accounts that we didn't cover at the stage. And then thereafter, we will be preparing the different forms or different types of the trial balances, and then conclude the accounting cycle by preparing the financial statements. The trial balance is usually prepared periodically at the end of the financial period. It's a list of closing debit and credit balances, as well as debit and credit totals of all accounts that were generated in the general ledger. It ensures that the entries are properly posted and balanced off in the general ledger. It's concluded by balancing the debit and the credit entries. Any discrepancies will be investigated and corrected before the financial statements are drawn. A trial balance has got two clearly distinctive sections, namely the real account section, which will only reflect the assets accounts, owner's equity accounts, and liability accounts. The second section will be the nominal account section, where only the income accounts and expenses account will be shown. There are three types of a trial balance. The first being the pre-adjusted trial balance, which is drawn before the consideration of errors, omission, and adjustment. Thereafter, the second trial balance that will be presented will be the post-adjusted trial balance. This is a trial balance that will be drawn to check the correctness of errors, omission, and adjustment. After the completion of the post-adjusted trial balance, the first set of financial statements being the profit or loss and other comprehensive income statement can be drawn. Then the last type of a trial balance will be the post-closing trial balance. This is a trial balance that will be drawn after all the nominal sections have been closed off to equity accounts. On this trial balance, the items that will be captured will only be the assets accounts, owner's equity accounts, and liabilities. A complete set of annual financial statements will consist of a statement of profit or loss and other comprehensive income, statement of financial position, statement of changes in equity, the cash flow statement, and the notes including a significant summary of the accounting policies. The Accounting Reporting Standard IS1 assumes that the financial statements are prepared to comply with the following accounting basis or principles. The going concern basis, which states that the affairs of an entity should reflect the fact that it will continue to exist into the foreseeable future. The accrual basis accounts for revenue when earned or expenses when incurred. Consistency of presentation requires classification of items to be maintained in subsequent periods. Materiality and aggression prohibits omission of items if material, if non-disclosure influences the decision of users. Offsetting of assets, liabilities, income, and expenses is prohibited unless permitted by the IS1 statement. The matching principle requires that expenses incurred should be recorded in the same period with related revenue earned. Lastly, the statement should be prepared at least annually at the end of the financial period. In this lecture, we will treat the first two sets of financial statements, namely the profit or loss and other comprehensive income, and the financial position. Starting with the statement of profit or loss and other comprehensive income, this statement will reflect the monthly activities for a period of 12 months, drawn from the nominal account section of the trial balance. In other words, the statement will only capture the activities from the income and expenses accounts in the general ledger. In presenting this statement, the heading should clearly reflect the name of the entity, the name of the statement, and the date of the statement. In this example, the name is ABC Traders, statement of profit or loss and other comprehensive income for the year ended 31st of May 2010. The first line will always be sales, calculated as turnover or sales excluding VAT after deducting the debtor's allowances or sales return. It will be followed by the cost of sales, which will be calculated using either the perpetual inventory system or the periodic inventory system. Cost of sales on the statement will be deducted from sales to arrive at gross profit. It will be followed by listing all the operating income accounts. For example, your rent received, your discount received, your interest received, interest on savings, and so forth. Remember that these incomes that are listed here should cover a full period of 12 months. Where income received exceeds 12 months, the overlapping months will be treated as income received in advance. This income that has been received in advance, it will be deducted from the operating income because it's not income for the current year. Where income received does not cover the full 12 months period, the income owing will be treated as accrued income because it's income that was supposed to have been received in the current year. It will be added to the total operating income. Then there will be other adjustment accounts such as the credit loss allowance adjustment. It will also be added to the operating income. Then the total operating income will be added to the gross profit to arrive at the gross income line on the statement. Thereafter, it will be followed by listing all the operating expenses. These operating expenses should also cover a full period of 12 months. When expenses paid in the current exceeded 12 months, the overlapping months will be treated as expenses paid in advance. These expenses that are paid in advance will then be deducted from the operating expenses because they are not expenses for the current year. Where expenses at the end of the year that has been paid didn't cover the full period, the amount that remains outstanding at the end of the period will be regarded as accrued expenses. These accrued expenses will be added to the operating expenses because they should be included in the current year. Then there will be also other adjustments accounts such as the credit loss, which is the bad debt which was written off. It will be part of the operating expenses. Also, the credit loss allowance adjustment, depending on the type of adjustment that we will be dealing with. It could be income or expense. Where credit loss allowance is an expense, it will also be added to operating expenses. Then at the end of the year where we bought stationery and some of the stationery remain unused at the end of the period, the portion that remain unused at the end of the period is regarded as consumable goods on hand. That portion will then be deducted from the operating expenses. Then the total operating expenses will be deducted from the gross income to either arrive at the net profit for the period or the net loss for the period. Earlier I mentioned the fact that the cost of goods sold calculation depends on the type of inventory system that is in use. Previously, We've done calculation of cost of sales where a perpetual inventory was in use, where we were given the markup on sales or markup on cost price. Here we will be doing the calculation of cost of sales where a periodic inventory system is in use. The cost of sales will be calculated by taking the opening inventory, adding the total purchases calculated as cash plus credit purchases, adding the railage and transport inwards, which are transport charges paid on delivery of goods that were purchased, the import and freight charges, deducting the purchases returned to arrive at the cost of goods available for sale. This calculation of cost of goods available for sales represent inventory that is sitting on the shelf that is ready for sale. To this, we deduct the inventory that remain unsold, which is the closing inventory, to arrive at the cost of goods sold. This is a calculation that must be reflected on the statement of comprehensive income. Please note that there are accounting terminology and phrases that you need to familiarize yourself with. We have mentioned phrases such as gross profit, gross income. Now we are introducing the cost of goods available for sales, then the cost of goods sold. Please note the difference and how these items are calculated in accounting. The next set of the financial statement is the statement of financial position, drawn by extracting information from the real account section of the trial balance. The format of the financial position statement will be in line with the accounting equation. In presenting the statement, the heading should clearly reflect the name of the entity, the name of the statement, and the date on which the statement is presented. In this example, the name is ABC Traders, Statement of Financial Position as at the 31st of May 2010. Starting first with the asset side of the statement, it should reflect the fact that assets are divided into two categories, being the non-current assets and the current assets. Starting with the non-current assets, the first line will be property, plant, and equipment. On this line, we will reflect the total carrying value of land and building, plant and machineries, office furniture and equipment, as well as vehicle. It will be followed by investment and then goodwill. Thereafter, list the current assets, which are the trading inventory, accounts receivable or trade debtors, income accrued, expenses paid in advance, bank if it's a favorable balance, petty cash, cash float, SARS VAT if it's a debit balance. Then conclude the assets by adding the subtotal of non-current assets to current asset to arrive at the total assets. And then it will be followed by owner's equity and liability section, where we will first reflect the owner's equity and then show the fact that also liabilities are divided into two categories, being the non-current liabilities and the current liabilities. Under the owner's equity, we will show the capital account total, then followed by the net profit as calculated from the comprehensive statement. We will add it to capital. If in the comprehensive statement we have determined the losses, they will be deducted from the capital amount, and then also bring in the drawings and deduct it from the capital. Then list the non-current liabilities, which are representing long-term obligations of the entity. Examples being the long-term loans, the mortgage bond, and debentures. Thereafter, list the current liabilities, which are accounts payable, income received in advance, accrued expenses, bank if it's an overdraft balance, SARS VAT if it's a credit balance. Then conclude the owner's equity and liability by adding the subtotal of owner's equity to the subtotal of non-current liabilities and current liability to arrive at the total equity and liabilities. The statement will conclude with the total value of assets being the same as the total value of total equity and liabilities. Let's work through this example. We are given a pre-adjusted trial balance at the end of the year 31st of March 2011 of ABC Traders. Note that this is a pre-adjusted trial balance, meaning a trial balance before adjustments, before any errors and omissions have been investigated. The trial balance has two distinct sections, with the section being the real accounts section. Under this section, the following accounts are listed: capital, drawings, equipment, land and building, vehicles, accumulated depreciation on vehicle, accumulated depreciation on equipment, the 10% fixed deposit, the loan, trading inventory, accounts payable, accounts receivable, and bank. Note that under this section, the accounts here that are listed are assets, owner's equity, and liabilities. I want to draw your attention to the accumulated depreciation account. This account is part of the assets, but it affects assets negatively because on the statement of financial position, you will see that it's deducted from the assets total so as to arrive at the carrying value. The next section of the trial balance is the nominal account section. Under the nominal account section, the following are listed: the sales, the cost of sales, though the figure or amount is not given, it must be calculated, stationery, salaries and wages, water and lights. Furthermore, additional information is given as: number 1, the trader uses perpetual inventory system and marks goods at 33 1/3% on selling price. Note that on the trial balance, the cost of sales was not given, but additional information gives us further details that will enable us to calculate the cost of sales. Number 2, credit losses of 1,900 should be written off as irrecoverable. Note that on the trial balance, we do not have credit loss at this stage. Number 3, the physical stock taken reflects the value of inventory on hand as 95,100, which is a different figure from the figure that is reflected on the trial balance as 97,135. We will therefore have to adjust the value of trading inventory to agree with the physical stock taken value. Number 4, provide an allowance of 5% for credit losses on outstanding trade debtors. On this line, we are providing or making a provision for unforeseen debts, which might be irrecoverable in the next financial year. Line 2, the 1,900, it's a definite losses. We have identified it as this that will not be recovered in the current financial period. So the difference is that item number 4 here refers only to a provision or an allowance that we should make in our books in anticipation of the losses of the future. Number 5, depreciation should be provided as follows. Equipment at 10% on reducing balance. Vehicle 25% on cost price. On the trial balance, we do not have the depreciation expense account. We will therefore have to bring it also into books. You are required to prepare the post-adjusted trial balance, meaning the trial balance after the adjustments. Prepare the statement of profit or loss and comprehensive income for the year ended. Prepare the post-closing trial balance and the statement of financial position for the year end. Starting with the preparation of the post-adjusted trial balance of ABC Traders at the end of the year, 31st of March 2011, showing the real account section and nominal account section of the trial balance. Note that the accounts that will change in value are the accounts that were affected by additional information. Therefore, the capital, drawings, land and building, equipment and vehicle will remain the same. The accumulated depreciation totals will change because we are to provide for depreciation at the end of the year as follows. For vehicle, 25% on cost price, which is 25% of 425,000, giving us 106,250, adding it to the opening balance of 125,000 to arrive at a total of 231,250. For equipment, we are calculating using the diminishing balance method. Therefore, we will take the cost price of 41,477, deduct the opening balance of accumulated depreciation of 19,000, multiply it by 10% to arrive at 2,248, add it to the opening balance so as to arrive at a closing balance of accumulated depreciation on equipment of 21,248 rands. Then under the nominal account section, we will reflect the expense depreciation. We will take the amount for the vehicle, add the depreciation for equipment to arrive at a total depreciation of 108,498. The fixed deposit remains the same. The bank account remains the same. The trading inventory changes to 95,100, which was the actual value after physical stock taking. The difference in the trading inventory will then be reflected under the nominal account section as trading inventory deficit, which will be an expense of 2,035. The accounts receivable will change because we are to provide for credit losses of 1,900, which must be written off as irrecoverable. We will therefore deduct it to arrive at the debtors of 52,000. Then under the nominal account section, we will reflect it as a credit loss expense, the amount 1,900. Then we are also to provide for the allowances for credit losses at 5%. We will therefore take the goods debtors, which is the amount that was calculated after deducting the bad debts or after writing off the credit losses. We will then calculate 5% of 52,000, which gave us the allowance for credit losses of 2,600, which will also be shown under the nominal account section as an expense called allowance for credit loss adjustment. The difference is the one that we will show in the trial balance under the real account section is the allowance for credit loss. The one that is reflected under nominal account section, it ends with the word adjustment. The loan account doesn't change. The accounts payable doesn't change. The sales value doesn't change. We will then calculate the cost of sales because it was not a given figure. We were told that the trader uses perpetual inventory system where goods are marked at 33 1/3% on selling price. We will therefore calculate the cost of sales by taking the sales figure of 410,000, multiply it by 67.67% to arrive at the cost of sales of 273,347. Stationary value doesn't change. It was not affected by additional information. The same thing with salaries and wages. We've already brought in the adjustment account, depreciation, the credit losses, the allowance for credit loss adjustment, as well as the trading inventory deficit. We can then balance the trial balance. If the two sides balances, meaning if the debit equals to the credit side, we are good to go with the next stage of preparing the statement of profit or losses and other comprehensive income. You will continue and complete the exercise.